Hey everyone, Steve here from 11ers, a channel where we talk about lucrative investment strategies and opportunities based on the requests from the 11ers Collective. Today we have John with us, who has managed millions and millions of dollars and hang out with the big boys. In the last podcast, we talked about how to get an edge over the professional investors and how to diversify your portfolio so that it's interesting and also maximize its gain. In this one, we're going to talk about exit strategies. And specifically, we're going to focus on three things. One is why we should set an exit strategy, ideally before you actually buy the stock. How do you figure out what your exit strategy is? And then lastly, what happens if the number you've had in mind was hit way before you originally anticipated? So without further ado, hey John, how's it going?
Hey Steve, thanks for having me on.
My pleasure. All right, so let's dive right in. Can you share with us your thoughts around, why you should know when to sell ideally before you buy a stock?
Yeah, first part, it's a good part of the thought process because you're kind of already considering when to buy just by buying the stock, whether you think of that as something that you're monitoring or just you're pulling the trigger. Ultimately, there is a value to each of these things, whether it's based on some type of valuation methodology that you're using. And frankly, a lot of other people are probably using some of the same ones, whether it's a DCF or some type of market multiple or some type of other assumptions. So knowing when something is relatively expensive or has a lot of upside assumptions baked in, or in the case of a short, a lot of downside assumptions baked in, then that helps you understand where we are in terms of, like, to use an analogy of a baseball game, which inning are you in? Are you near the beginning or are you near the end? And that's a good thought process to have ideally before before the end of the game.
Yeah, I think that's a really interesting way to look at it because, for us who has a bit of a product and business background, we look at a business as one that has cycles, right? They have explosive growth cycle, they have this whole maturity cycle, and then most business, either they figure out how to capture more of the market and have more explosive growth, they start tapering off, right? I mean, that's generally speaking the cycle. And so I think that's kind of how you figure out where you are in terms of your investment, whether how big the growth opportunity is. Are you just milking a old cow or are you riding a rocket ship?
Yeah, I agree. To your point, when you look at anything that's even doing super well or doing super poorly, let's say with airline stocks, and assuming they're not massively cash flow negative and they have enough money to sustain it for a long period of time, you want to think about, okay, what are the scenarios that could play out? And using coronavirus, what everyone's debating, and frankly no one knows, is the V-shaped recovery, all the different little shapes that everyone's coming up with in terms of recoveries.
Yeah.
But at the end of the day, the question is, what is being baked into these stocks? Whether it's railroads, airlines, et cetera, et cetera. So you're just using coronavirus as an example. If you did all the calculations and things like that, and you realize that people are baking in 3 or 4 years of coronavirus, that might be interesting because then, from a target price perspective, there's a lot more interesting things that could happen, and the probability of such a scenario in your mind may be low probability, which means that this might be an interesting as a long. Or vice versa for something that's growing super, super, super well. Let's say a company that's going 30, 50% every year. And of course, everybody already sees that. So to some extent, that's being priced in. And then if the stock is at a certain multiple where that multiple assumes a consistent 30 or 50% or even faster growth every single year for the next 5 years, let's say, and you're thinking, that seems possible, but maybe the probability of that is 25%, and most likely they're not going to do that. That might be interesting in terms of thinking, okay, when do I take profit on this long or something, maybe a short if you're brave enough, things like that.
That makes sense. And I want to just circle back on a specific point that you mentioned. So if I'm talking about a stock that the entire market thinks will do well because of COVID, let's say. So Peloton is a great example, I think, because I think the business value makes sense before COVID, and the business value got accelerated during COVID. And that was the video I basically put out. But to your point, I think we reached a price point where it seems to me like people think that COVID is going to last 3-4 years. That's what the price is telling me. One of my concerns was that the growth projection will, at the very least, slow down if COVID ends, because they're getting free marketing right now. But if everyone is this optimistic, then they're basically assuming that the growth will continue, which to me basically means that the market thinks COVID will continue way longer than how we're talking about it right now. Is that the right way to look at it?
Yeah, I mean, I haven't looked at numbers for Peloton, but yeah, if if you're looking at the growth numbers and the forecasts by sell side and what the price is implying, then that would absolutely be the right way to look at it. I mean, ultimately, the market is in an interesting spot. Like, if you see a valuation where, to your point, it's expecting. Let's use Zoom as a very simple example. If the price of Zoom was implying that every single person on Earth had 2.5 Zoom accounts, then that would obviously be a super bullish case and something where you would be one looking to take profits if you own the stock, or potentially looking to short if you if you were kind of in that camp. I don't know if that's the case. I haven't looked at the stock, but those are the kind of scenarios where it's pretty clear what is getting baked in and what's not. That said, there's also two parts to kind of think about these things. The first part is like, what is the business as it stands today? What is the growth rate as it stands today? And ultimately, what is the adoption of Peloton bike, Zoom, conference software, etc. Mm-hmm. So that's a reasonably clear way to look at things. The second part is you're always also investing in the management team. So depending on your research on these types of management teams, their success historically, are they creative? Are they more just like keep the boat steady kind of people? Those things are actually quite important, because ultimately that means how quickly can a company adapt and perhaps spin up a new arm of a business to deal with things, or pivot very, very quickly to deal with things. So, when you think about Facebook during IPO, actually most people hated Facebook and actually went down, and everyone's like, yeah, it was such a great short. But what actually happened then after that was Mark Zuckerberg was like, holy shit, we know we need this transition from desktop to mobile. I think that did that super, super well. So those are kind of the management teams that like can execute and can pivot. So ultimately, that's the second part, the unknown, that is not really forecastable, but you can sort of understand the type of team based on how some of these management teams are.
That makes sense. And I think one of the biggest takeaways of what you said is that you should take into consideration how capable the management team is in terms of capturing new value that wasn't already baked in. You need that in order for the stock to be essentially worthwhile to be investing in for a swing trade or a short-term trade. Because otherwise, most likely the value of whatever you think is good is already built into the stock price.
Yeah, another way to say that is a more dynamic management teams creates more catalysts.
Yeah.
So a very, maybe not as adventurous management team, let's say IBM, there's almost nothing that ever happens.
Yeah.
Or 3M, let's say, right? So you pretty much know what's going to be happening for the next 5 years, probably.
Yeah.
Versus, some of these other tech companies, especially the more recent IPOs, there's so much that they could potentially capture if the management team, spins up new arms or, lands and expands within new categories.
So let's see if I can put you on the spot real quick. Let's talk about something really boring and see if we can figure out, if we were to invest into it, what should be the exit price. Does that sound fair?
Sure, let's do it.
Okay. So a stock that I was actually looking at for a variety of reasons is Scott's Miracle Growth. So they basically sell dirt.
Yep.
But the interesting thing to me is that they have I think it's 3 different companies combined at this point. And they own a shit ton of the market, anything that has to do with dirt. If you Google dirt on Amazon, basically first half of the page is all from Scott's Miracle Grow, from their top companies. And at least the way I look at it, you think the company is pretty boring because it's dirt. It's something that people will always need, right? Both for home improvement, for gardening, and also a new emerging market I mean, like it's been emerging for quite a long time, but it's essentially cannabis market, which they need a lot of high-end soil, essentially, right?
Ah, yes. I remember the stock rallying a lot many years ago. Yes.
Yeah, so this stock has seen a lot of up and downs. I mean, I'm just looking at the 5-year chart right now. 5 years ago, it was $60. Now it's a buck 60 ish, and it's definitely had its up and downs within this time frame. If we just look at this company as something that will continue to grow, as opposed to now there's something interesting and it might grow faster, right? If we just look at it as a positive gainer, how would you approach this in terms of figuring out what price I think this stock should be worth in, let's say, a year from now?
So I'm not sure which markets they target in terms of like consumer versus corporate, but let's just say, it's 50-50 or something. So let's just say those are the two. And then within each of those, obviously there's the volume side and the price side. So literally every single company, every single line item is price times volume. Your income is price times volume, right? Well, volume of one for price of your income. And every single revenue and cost item is a price and volume equation. So when you think about, let's say, Scott's Grow, you're hypothesizing that the growth is mainly coming from the corporate side. So we're just talking about cannabis, let's say, hypothetically.
Okay.
So then the question is, okay, let's get some data on this. What does it look like? And then the second part of that is, is the number of cannabis companies using Scott's Grow increasing? So that's one part of the volume. That's the volume. But then the second part is the price. So can they squeeze more price? Like, I don't know, whatever the price of fertilizer is, let's say it's $1 a pound, I'm probably wrong that, but let's say it's $1 a pound.
Sure.
If they can move the price to, let's say, $1.10 a pound, that's quite interesting, because ultimately that additional 10 cents, assuming all other costs equal, like the cost of potash and other ingredients is equal, that means that that incremental 10 cents flows all the way down, versus when you generally land, there's a initial cost associated with that, whether it's paying the sales guy or paying additional costs for the transportation, etc. So the beauty of a price increase, price more often flows all the way down to profit. So trying to understand that, in this case with Scott's Grow and let's say cannabis, I would be super interested in understanding, okay, what's the number of cannabis companies increasing in the U.S. and how many of them use Scott's Grow today? How many of them use Scott's Grow, by my estimates, in a year from now? And what price do they pay? Does that price increase? Does the price decrease? And then you have a really good revenue number, but you also have a really good indicator of what profitability looks like in a year from now as well. And ultimately, that flows all the way down to, okay, is Scott's Grow, they obviously grew revenue, but are they growing profits faster, not faster? And that's called operating leverage. Tying that all back to valuation, let's say you forecast that out for an additional 5 years to use a discounted cash flow model, or you forecasted that out another 1 year, let's say, to use a price to sales multiple or some other type of or price earnings multiple, most likely. Then you have a really good indicator of, generally what does this type of company trade at based on the relevant growth metrics. You can get a sense of what other people will ultimately think when they're valuing this thing. Because at the end of the day, it's nice for yourself to have a price target, because it's an indicator of how other people value things. I mean, you can create any multiple you want. I mean, 1,000 times price to sales for Scott's Grow, but at the end of the day, it doesn't matter unless you understand how the majority of the rest of the market also thinks about what is a quote fair value for Scott's Grow or frankly any stock.
So just to kind of reiterate, because I think I heard 3 main points around this discussion. First is the delta of the growth of the market between when you buy and when you would like to sell. If there are markets, in this case like cannabis market, you want to know how big the cannabis market is growing, so you have an idea of how much more this business will be growing within like this 1 year period. The second point is the delta of the cost of operations, which I think probably the only realistic indicator will be coming from the management team or maybe like industry trends perhaps, but like the cost in terms of whether their production is going to go down, or maybe they're maximizing the scale of economy more, and so that decreases the cost, so that creates a potential for more value to be had as a shareholder. And then the last point I think I got was the delta of the price of product. I agree with you in that. Like, it's very interesting because if you increase the price of the product, if everything else stays the same, then you're just automatically creating more top line and bottom line. And so that is the most obvious way of looking at it. This is a great way to compare your results with what analysts think, so that you're not just going blindly with what the analysts say.
Exactly. If you look at what these quote analysts are saying, I mean, you got three different analysts, they're gonna have three completely different assumptions.
Yeah.
And they generally those fundamental assumptions are then just not randomly, but like they end up at a very similar target price based on a variety of different metrics, because no one wants to be too far from median target price. The analyst's job is not to get stock right from the sell side perspective. The analyst's job is to write interesting reports so large funds trade with investment banks, and to write interesting reports so that future companies looking to IPO within that space can see this analyst and their firm as a very intelligent player in the space. So the analyst doesn't work for you because you're not paying the analyst.
So that's a very interesting way to look at it. I never actually thought about it that way. Originally, I was going to ask you how to figure out when I should sell this stock. But at least based on our current discussion, it sounds more like I should have an idea of when I want to sell. And then based on, let's say, I want to sell it in a year or in a 3-month period, I can figure out what that value is.
Yeah, I would say like you should, have a base assumptions going into, any results. But then, as the company reports and the company performs in a certain way, you got to be honest with yourself whether the company is actually doing what you think it's doing, or you're just completely wrong. Because both those things happen. And the third is maybe the company is doing exactly what you think they're doing, but the rest of the market doesn't care. In which case, then you're also wrong, but just for a different reason, because you've anticipated the other investors within this stock behave in a certain way, which is not true. So one great example of that is like Tesla, right? Like Tesla sells significantly fewer cars than everyone else. And the people that would have hypothetically, I'm sure before Tesla, I'm sure like those research reports were like, oh, this is the valuation or the market cap per car, or something along those lines.
Right.
But then Tesla came along and blew that out of the water. So, there's clearly different types of investors within these spaces, and that's something to be very aware of as well.
That's fair. Let me ask you this, because I think this is a very, very common way of how new investors look at investing in general. They look at a company like Tesla and they say, man, this stock is hot, this business is interesting, and they are in a space that is up and coming. At that point, you'll find some YouTuber or the closest friend is like, okay, now that I'm invested, how high can it go, right? And as you pointed out, there are these more methodical way of looking at it, more traditional way of looking at it. But, I'm expecting something crazy to happen for the stock split, and I do expect the thing to normalize and go back to the original price. But I'm just saying, like, there's going to be hype, and that's going to boost the stock price. That's going to be the unknown, right? And if that's my play, do you think it's even reasonable to figure out what value I think that should be, so that I have a benchmark as to what the selling price, or do you think that's just like voodoo science at that point?
It sort of depends on your investment horizon. So if your investment horizon is like, 1 year and it sort of hits your target price, or it gets really close to your target price, like based on your assumptions, it happened for some totally random reason, like a stock split or something, which is super odd. Then you might just want to take profits because it's pretty much already there, and then you're waiting for these things to happen with the stock, whether with the fundamentals, whether it's like selling more cars or selling more produce or selling more dirt, and then it's like, okay, well, this random thing happened, it's getting to the right price. Just because it happened for a totally random reason doesn't make it, not money. So you still take profit. In my opinion, unless you're super long term and you're like, okay, I'm investing this in my IRA or something, and like, this thing's gonna still compound every 30% for the next like 20 years, and I'm happy to hold it. If that's your play, then keep it.
That's fair. But let me ask you this in a different way. Sometimes I do quarter earning trades. So I have an idea about a company. I buy in like 2 weeks before the earnings come out, because I have an indication, in my opinion, an edge that tells me that there's going to be surprise involved, and that, as we talked about in the past, creates explosive growth. The question here is that, should I bother coming up with a number of what that exit number should be 3 weeks from now? Or should I just be happy that there was a positive outcome?
So you bought a stock and then you're waiting for the results, and you want to say whether you should have a target price in mind, or if it hits a certain price, you should sell.
Yeah, like if I'm just playing the earnings game, I'm saying like 3 weeks from now, I think the stock's gonna go up, and then should I come up with a price of what that exit should be, or should I just be happy that the stock did go up like I thought it was gonna, and sell?
Oh,
Or
yeah, I see what you're saying.
yeah, the stock did go up. The news was positive like I thought, but perhaps it should have gone higher. And I'm like, I'm having FOMO right now. Should I hold on? You know what I mean?
Oh, I see what you're saying. Yeah, so I guess two parts to that, right? One is whether an incident will happen. In this case, let's say a stampede of additional investors coming in.
Yeah.
And the second part is, so that's binary. It's either going to happen or not happen. And then the second part is the quantification of that. Is it going to be a lot of investors with a lot of cash, or not?
Yeah.
And I think for something like, my personal opinion, for something like 3 weeks, there's probably not that much fundamentals that are going to change in 3 weeks. So if it is, and especially if it's some type of like announcement of there's a, I don't know, a hypothetical stock split or some type of announcement where it takes many years to play out, and maybe it is just a short-term bump. I think it's super hard to be able to say, hey, this should be a 15% increase versus a 25% increase. I mean, that's just a function of like almost how many people read the news or how many people react in a certain way. But as long as you are able to get kind of identify the fact that people will react in a certain way in the first place, that's good enough. Just knowing that the sun is going to come out in this case is valuable enough.
Yeah.
I don't think you need to calculate the trajectory of the sun.
Okay. My interpretation of what you just said is that if I think I have an edge on the earnings coming out for a particular business, that I think the analyst missed something and it's going to get more eyeballs onto the stock that I want to invest in, and it's going to create a growth opportunity. If the stock goes up, I should most likely take profit. With the news that just came out, I can essentially map out what the long-term potential price is, because that's essentially confirmation for what I think the gain is. And that gain shouldn't be a short-term thing, right? Because it's a business strategy.
Yeah. So within that, if it's like the announcement is like something super random and not lasting in terms of actual fundamental power, then it's like, just take whatever you get.
Yeah.
And the other hand versus like, if Slack announces that they're gonna go super aggressive against Zoom or something, and let's say hypothetically people like that, that's a real long-term potential business change. Yeah. In which case, maybe you keep holding on to it depending on what the stock does. So it sort of depends on whether it's a really short-term thing or it's a real kind of everlasting, meaningful strategic core change.
Okay, so I think that's a really interesting point you just touched on, because I think that is effectively what I'm trying to get at least the way I was taught how to trade stocks. There's that whole thing like the idea of like good news lasts one day, bad news lasts two kind of thing. Have you heard of that saying before?
I've not heard that saying.
It was in a book somewhere. But anyway, I guess what I'm saying is like, if the news came out positive, should I be collecting gains and expecting to buy on the low, even if the news is supposed to be like a long-term thing? Or you think that's just like a crapshoot and I should really look at it more long-term than that? Does that make sense?
Yeah, I think it depends on the stock. So if it's like, let's say it's a company that is capital intensive, so like some big factory in a relator or something like that, where you got to invest $1 billion in a factory in order to actually do something. They may have a huge balance because they got a new order from somebody, and that may be terrific news. But the next step is, okay, now we got to invest a few $100 million or $1 billion to build a plant, depending on the size of the company. Let's just say hypothetically that's taken as negative news. So in that case, I would probably take profits because it's going to be a while before they really fulfill those orders. You're only going to be really recognizing those bookings as revenues when you actually sell that to the end customer. So in the middle, you're going to have this massive capital expenditure expense, which sometimes is taken positively, depending on, again, the investor base. But you got to think about whether you're kind of okay just sitting there for 6 months, or most likely a year and a half to build that factory, just waiting there for that. So it sort of depends on kind of that side, I would say. The other side is like, if it's a software company and they say something very strategic and the stock gaps up like 30-40%, and you're thinking, okay, well, are they actually going to do this or not going to do this? Again, it sort of depends on, does the software exist, or do they have to invest $200 million to build the software and also to develop a sales team and a go-to-market team, or they just create this really small thing and is it going well? So one example of that is mobile gaming companies, right? So mobile gaming companies are, they come up with like tens of games a year, or if not more, depending on the company. Mm-hmm. And sometimes they report like, hey, this game is doing really, really well, and then that game already exists. It's already doing well. It's only gaining more momentum. So in that case, if something gaps up 20%, then that's probably going to continue and not bounce back the next day, because the game still exists and it's still continuing. So that's the way I would think about it. Is it a big jump because of something that's a great idea but requires a lot of execution risk, or is it something that people didn't really see, wasn't on people's radar, but exists and is already gaining momentum, and you're just kind of waiting for that momentum to continue?
That's a really good point, because I think this comes down to, especially with the fact that we're essentially in a bubble and people create trade frenzies. People are interpreting positive news all the same way. And so, like, if the positive news actually takes a long time to actually execute, then I should probably take profits sooner, because soon enough, like, these investors will realize the stock is going to be boring for a bit.
Yep.
Yeah, that's a really good point. Very interesting. This is actually, on a side note, this is actually why I sold Disney, man, because I mean, I love the brand, and they're definitely, I feel like they're cutting the arms to save the torso right now. And I 100% agree with what they're doing, cutting off, like, non-core business functions basically, and leaning even harder into digital. But I just think that it'll take time for that execution to actually be worthwhile and actually show up on the balance sheet, because they're slumping at like 42% of their usual top line, and that's a massive amount of money.
Yeah, I think people, it seems to me the market is rewarding people more for growth than for cost cuts. Like when someone reports 30 or 40% year-on-year growth or something like that, people are like, oh shit, that's nice. And the stock sometimes goes up depending on the expectations. But it doesn't seem like the average investor, at least in this market, is saying, oh, you guys cut costs so well.
Yeah.
Like your stock.
Yeah. So the last thing I want to touch on is, and I think you actually answered this question in so many ways, but if I set a price target, and an example is this Genius Brand International that we talked about, where it's a penny stock right now, and the management team is fascinating, and they're hiring all sorts of interesting people. By the way, did you watch SpongeBob as a kid?
I did not.
Okay, well, apparently they hired the lead writer for SpongeBob as to their team. I mean, like, I think it's freaking fascinating how many top line people they've hired, and they diluted the stock so much that they've raised $50 million in the bank. For like, it's fascinating how much advantage they're taking from the shareholders. But frankly, I mean, like, if you're a business, you're looking at how to make this business sustainable. I frankly don't blame them, right? I mean, it's an asshole thing to do. Yeah. It's an asshole thing to do, but like, I guess what I'm getting at though is that, like, they're executing to the strategy that they've always talked about. They're capturing more TV shows. They just acquired Yu-Gi-Oh! Like 200 different episodes. They're planning on launching new stuff in the beginning of next year, and then they also have started launching toys in all sorts of, like, partner with Mattel and launch all sorts of toys in all sorts of marketplaces. So to me, that is a long-term growth strategy. Whether they work or not, that's a long-term growth strategy, right? I mean, like, that shit's gonna build momentum ideally, and eventually be worth something ideally a year from now, as opposed to what it is now. Whether you think that this revenue is going to be a lot or not, if I say that I think that this business is going to be making, let's say, $50 million a year, that's like 10x what they are at right now, just making stuff up right now, just to make things
Sure.
simple,
Yep.
right?
Mm-hmm.
If I put that out there, for some reason they announced the news in a super positive way, and this stock jumps 10x. I'm expecting this business to be long tail, and the end result is supposed to be a year from now, after all of these execution like compound into a worthwhile company with good financials. Instead, they announced some really, really good news, kind of like what you insinuated, right? Like they basically said that, for whatever company, they said that like, we're gonna do this as a long-term strategy, and then people think this is the hottest shit now, and the stock price jumps up. Do you think I should be looking at this company in a different light, in terms of like, I don't know, the PE ratio is measured incorrectly, kind of like how Tesla is right now, right? I mean, that's kind of how I'm looking at it. Or do I think that this is like everybody's looking at this company wrong, and I should sell and take profits immediately?
Let's just say it jumps to $50. So it's
Yeah.
$1.06 right now, $1.60 or something.
It's $1.60, yes.
Got it. So let's just say it jumps to 100, just to make the math easy.
Okay.
So if it jumped to 100 tomorrow and your target price is 100, that was supposed to happen in, let's say, 12 or 24 months from now.
Mm-hmm.
Ignore the fact that it's $1.60 right now. Just imagine the stock is $100 right now, and your target price is 100. Would you still buy the stock? And the answer is probably no. So it's all about what happens in reality versus expectations. And that's where opportunity comes in. That's why stocks move ultimately, because of reality versus expectations. So if the reality that is being implied based on, let's say, $100 stock price is also equal to your expectations, or let's just say another way, other people's expectations of reality are the same as yours, and that's fully reflected in the stock, and then the company actually reports fundamentals that are exactly what everyone expected, the stock's not going to move. So that's if the stock went to 100 and your target price is 100, I would be like, yeah, I'd sell nothing. It doesn't matter that it happened now versus 12 months from now.
At the current stock price, am I willing to buy it if I didn't hold it? Right?
Exactly.
That's actually a really great way to look at it.
Yeah, you got to remove the emotion out of everything. Just wake up every day fresh. You're not you from yesterday, let's say.
That's fair. All right, John, I think that was super, super useful. I think we have a better idea in terms of why we want to set an expectation of an exit strategy before we buy. We also discussed on how to ideally figure that out from the perspective of a professional, and also, look at it from an angle of perhaps being too optimistic, figuring out how to look at hype and how to deal with those kind of situations. Is there anything else you want to add before we log off today?
No, it's great talking as always. Thank you.
Great. Thanks a lot for your time, John. I'll see you next time.
All right, take care.
Catch you.
Yeah, bye.
Thank you.